Amazon's march up from its earnings release is huge. It's up 64% year to date. And we got a lot of crap about our Amazon video we did last week, Mo.
Mm-hmm.
We're going to go through it again. We're going to go through the numbers. We're going to sit here and teach the process. The process that we're trying to teach is based on a few fundamental beliefs. One, when you buy a stock, you're buying a piece of a business. If you pay a reasonable price for that business, as the business grows, you will grow with the stock.
All right.
Another thing we're trying to explain to people, every investment is the present value of all future cash flow. Now, if you're a beginner investor or even an intermediate investor, it might be hard to understand that statement. What that means is when I buy something today, my return is going to be based on all the money that is going to happen in the future. But we don't know what the future holds, so we have to make assumptions about that. All we're trying to teach you is not to overpay for a good story. That's all we're trying to sit there and say. We find that people fixate on this great story, and all they say is, this is amazing. And what I always tell people is, when they tell me about a company they love, and they focus only on the story, I say, fine, add 2 more zeros to the stock price. Has your story changed? No. Okay, well then it's only based on a story. But you've got to combine the numbers with the story. You got to realize that it's possible to overpay for a good thing. And just think about that when you think about your favorite thing that you like to buy, whether it's a car, purse, shirt, whatever it is. If there's a price to pay that is too much. The same thing happens with investing. So if this makes sense to you, stay in with this video. Whether you're a beginner or more advanced, it's great ways to learn and repeat in your head the things you need to learn. So Amazon, it's on its march up. It's at $140 a share, up 64% year to date, up 32% in the last 3 months. Man, Mo, all-time high, though, still not as high as it was 2 years ago, 188.65. Somebody was saying that our watch list price before was laughable. I think it's laughable that it's been over 2 years and this amazing company, which has more revenue and more profit, is still lower. I think it's laughable that the company can't make money off its biggest business.
They're literally doing over $500 billion in revenue.
And all of that profit comes from one business, AWS, right now.
Yep.
Guys, I think Amazon's belief is we want to be just everything for everybody. We don't care if we make money on it or not. Why? Because the last 13, 14, 15 years has allowed them to do that.
Yeah. Why change?
Why
What's
change?
the incentive to change? It's worked.
It's
People
worked
still
so
buy
far.
it. People still buy the stock. They still dilute you. You still buy it.
And guess what, guys? I use Amazon 84,000 times per day.
Yeah, I get it. I got a package this morning.
Every single day I get a package for something I don't, toilet paper I need yesterday, toilet paper done. Guys, I can still love a company, but not love the stock, and vice versa. We're here to focus on the fact that don't get your bias about the company to force you to go buy the stock. The whole adage, people say, well, Peter Lynch says buy the companies you love. No, he doesn't really say, yes, he says that, but he goes one step further. Don't overpay. Go understand what's going to drive the profit for that company. Because if you pay a reasonable price and the profit grows 10% a year, you're likely to make 10% a year.
Mm-hmm.
That's it. It's very simple, right, Mo?
Yeah.
All right, so let's check out the 8 pillars on Amazon. And remember, if you have our software, you can customize your pillars up to 12 different pillars. So there's like 4 quadrillion different variations. But Mo, now it's 6 X's. The only growth we have is revenue growth and net income. But look at this. Cash flow growth is negative. But guys, I'm going to defend Amazon here. They're investing a lot more into shipping, into warehouses, et cetera. If you go look at their cash flow statement, their capital expenditures right here have skyrocketed. It was $13 billion back in 2018. It's $58 billion now. It's been over $50 billion for the last 3 years. They're investing heavily to make the experience better for you. The question is, how do they translate that into profit? Because guys, it's been a long time. Their profit's been hard to come by. Let's go to their income statement here. Yes, there's been profit for the last 7 or 8 years, but this has just mostly been driven by AWS.
Mm-hmm.
Go look at their history of AWS, for those you don't know, is Amazon Web Services. It's their cloud computing business. It's the leader. It's a very, very high margin business. But guess what? High margin means a lot of companies got into it.
Yes.
Microsoft's into it. Google's into it. IBM's in it. Every major player is into it.
Major players
Oracle.
and small players.
And small players.
Everybody's in it.
So as margins are huge, people enter, and what's going to happen to margins? They're going to contract a little bit. What level? I don't know, but they're investing a lot in these businesses. I just have a concern about where are they going to make their money in retail? They're not making their money in retail right now.
Yeah.
And if they are, it's a very small percentage of their overall profit. And that's concerning for me. Their average profit in the last 5 years is $15 billion. Their average free cash flow in the last 5 years is $6 billion. There's a huge difference between profit and free cash flow. Huge difference. Now, they've really increased, like I said, their capital expenditures. But at some point, it's got to be like, guys, you got to ask the question, hey, when's this going to happen?
Yeah.
They do like you said, Mo, they do $500 billion in revenue.
Right. And it's always like, they go after one project, they crush it, they do really well, and then they just go take all that money and go try to crush something else.
Yeah.
And that's cool, but at what point are you going to
make money?
Shareholders and make money?
Yeah.
Yeah.
You've got to be able to. Yeah. And guys, this revenue growth, listen, if I were you, I'd be like, oh my God, look at this revenue growth. This is incredible.
I would think they're crushing profit.
Yeah, I'd be like, oh, their profit's
crazy.
up 10 times.
Yeah.
And by the way, they were losing money here, so yeah, it is. But $500 billion in revenue? I mean, come on. Guys, Walmart is a brick and mortar store. They do about the same in revenue. They make more money than Amazon did last year. Isn't that a little disturbing? Yeah. Brick and mortar with so many employees, the number one employer in the country, essentially, and they're making more money. Again, they're not going to have, hopefully, the profit that Amazon has. And I know that's a very, very tough thing to understand here, whether you're a beginning investor or an advanced investor. It's very tough to sit there and say, how is this not going to pay off for them? I mean, it's hard to understand that, but I just sit there and say, okay.
Hasn't so far.
So let's see what analysts are saying, Mo.
It hasn't even showed an inkling that it's going to work so far.
Well, look at this though, Mo.
Let's see.
Look at the analysts. Expecting $2 per share here and $6 in 4 years. But guys, remember, the stock's currently at 140. If you assign it $6 in profit 4 years from now, that's a PE of 23.3. So you're paying 23 times the analyst's expected profit 4 years from now. You're paying 70 times this year's profit. Is that reasonable? I don't know. That's the hard part about investing. That's the hard part. Look at revenue growth. Look at this. You saw this the last time in our video. Yeah. They have almost $1 trillion. They have $900 billion in revenue estimate in the next 4 or 5 years.
Look at that. Some analysts have them at 1.04 trillion.
Oh, wow. I didn't even see that.
Yep.
The high range of the analysts is 1.04 trillion in 2027. Again, what's the profit? So at $6 a share, how many shares outstanding do they have?
Let me go back and look here.
10 billion. That's $60 billion in profit. 60 billion in profit they're estimating. All I did was take $6 per share, multiply it by 10.4 billion shares, and we're at $62.4 billion in profit. The high side is basically $100 billion in profit. Okay. That gives them a bottom line profit margin about 12% on the high side the analysts are expecting. So why do we need that? Well, when we did our stock analyzer tool the other day, this stock analyzer tool allows us to take the estimate, our assumptions about the future, and figure out a price to pay today. It doesn't include the balance sheet. But we have to make assumptions because we don't know the future. We don't know it at all. And we believe in assigning a low, middle, and high assumption range for revenue growth, profit margin, free cash flow margin, and then what PE they're going to sell for. And finally, our desired return. Now, if you like this software was used over 2 million times since it started as part of a big package of all of our tools, and especially our community of thousands of investors who talk every day. So if you like this, you want to check it out. It's a little over $1 per day. Check it out, everythingmoney.com. It's a no-brainer, guys. It's everything, all these 10,000 companies, all the software on your phone, on your computer, readily available. Forget about 1,000 songs on your phone. You've got 10,000 companies on your phone with all their financials and history and news. Check it out. So let's go back to the last time I did Amazon. Oh, it was Friday. It was Thursday.
Yep, Thursday.
These are our assumptions. Now, I'm going to go a little bit crazier.
Okay.
I'm going to do something where I'm going to change the profit margin to the highest of assumptions. But I'm going to go a little bit lower because it can take time to get there.
Okay, I'll keep mine what we had, and then we can show both.
I'm going to go 4, 7, and 10.
Okay.
Okay? Mm-hmm. I'm at the Analyze button. So, if you believe the highest of high assumptions, 14% revenue growth, which would take its revenue.
Oh my God.
from 500, so for 10 years from now, 1.14 to the 10th power times 538, we take them to $2 trillion in revenue in the next 10 years. Yeah, probably gonna do pretty decent buying it today. Low side, 35, middle, 78. Guys, again though, here's the issue. This middle assumption is based on profit margin they've never had. 7% bottom line margin for a year. They've never had that. I shouldn't say that. I don't think they've had that for a full year. That's what's hard for me.
And even if they have, it was short-lived. And
So
they're not on that trajectory right now.
So you have to sit there and say, are you willing to, even at that high level, it's hard to even justify today's price.
And it sounds like we're beating this up, but again, we love the company. We're going to continue to use it every single day, but it's hard to make an investment in this.
And for those of you who say, oh, that'll never happen, the stock price, okay.
All right,
We heard the same thing about Google when I said 150 on Google is too high and we think sub 100. It'll never go sub 100. It was $83 within the year. Stocks fluctuate. So guys, if you like this video, please subscribe. Make sure you understand it's a good place to learn if you're an early investor. It's a great place to enhance if you're a more advanced investor. Check out our software, everythingmoney.com. Thank you.